Okay, so you want to buy a car wash empire. Not one car wash, an empire. Dozens of locations, gleaming tunnels of foam and spinning brushes. Cars rolling through nonstop from 6 in the morning until closing. And every single one of them paying you a fee for the privilege of getting clean. It sounds like the simplest business on earth. Water, soap, a conveyor belt, and a line of customers that never really stops. Because cars get dirty every single day whether the economy is booming or crashing. That's the pitch private equity firms have been making to investors for the last decade. And it's the reason car washes have quietly become one of the most aggressively consolidated small business categories in America. The problem is that almost everyone who buys into that pitch, from individual owners to some of the largest funds on Wall Street, discovers the same thing a few years in. This business is not as simple as it looks, and the empire part is exactly where things start to go wrong. Before you make a single dollar, you need to understand what you're actually buying. Because car wash describes at least 3 completely different businesses wearing the same sign. A self-serve car wash is essentially a coin-operated utility. A few open bays where the customer does the work themselves with a pressure wand. Minimal labor, minimal revenue per car, but also minimal overhead. An in-bay automatic is a single mechanical unit that rolls over a stationary car. Still fairly hands-off, still modest revenue. And then there's the express exterior tunnel, the model that has taken over the industry. A conveyor system that pulls dozens of cars an hour through a fully automated wash in 3 to 4 minutes. Almost always paired with a monthly unlimited membership subscription. That third category is where the real money, the real land, and the real risk all live. And it's the one we're focused on, because it's the one investors have been racing to buy for the last 10 years. Say you want to build one from scratch rather than buy existing locations. The land alone is a bigger fight than most new owners expect. A modern express tunnel needs somewhere between 1 and 2 acres, positioned on a high-traffic corridor with excellent visibility and easy in and out access. Exactly the kind of parcel that fast food chains, pharmacies, and gas stations are also competing for. In a strong suburban market, that land alone can run anywhere from $1 million to $3 million depending on the metro. Then comes construction. A full express tunnel building, the conveyor system, water reclamation equipment, vacuum stations, and the canopy. Typically costs $3 million to $5 million all in, sometimes more in expensive markets. Add site work, permitting, and the months of delay that come with local zoning boards that are often skeptical of a new car wash going in near residential neighborhoods. And you can easily be 2 years and $5 to $8 million deep before your first car rolls through the tunnel. Buying an existing wash is usually the faster path, and it's the one private equity has overwhelmingly chosen, because the entire strategy depends on speed. Individual, well-run express washes with an established membership base commonly trade for anywhere between $3 million and $8 million. Priced as a multiple of EBITDA, the cash flow the business actually generates after operating expenses. In hot markets, with buyers competing aggressively for scale, multiples on quality assets have been reported in the range of 10 to 15 times EBITDA. Extraordinarily high for what is, underneath the branding, a fairly simple mechanical operation. Why would anyone pay that much for a car wash? Because of what happens after you own more than one. Here's the layer that actually explains the entire private equity car wash boom, and it's not really about the cars at all. It's about the membership. In a traditional pay-per-visit model, a wash might charge $15 to $25 for a single exterior clean. But the modern express model runs almost entirely on unlimited monthly memberships, typically priced somewhere between $25 and $40 a month, letting a customer wash their car as many times as they want. This single shift changed the entire economics of the business. A member who washes their car twice a month at $30 is already getting more value than paying per visit, so the incentive to subscribe is obvious to the customer. But the real magic is on the owner's side. Once someone subscribes, their car payment hits your bank account automatically every single month, whether they show up once, 10 times, or not at all that month. Some operators report that a meaningful share of subscribers rarely use the wash after the first month or two, yet the recurring charge keeps landing. That's not a coincidence. That's the business model. You are not really selling car washes anymore. You are selling a subscription that happens to come with a car wash attached. And subscriptions, as every software company on earth has already proven, are worth an enormous multiple of one-time sales. Because the revenue is predictable and it compounds. This is why acquirers pay 10 to 15 times EBITDA for a single well-run location. They are not valuing the wash. They are valuing the membership base, the recurring, sticky, automatically renewing bank draft that keeps arriving whether or not the member ever pulls into the lot again. So the math looks incredible on a spreadsheet. Buy a location with 3,000 members paying $30 a month, and you're looking at $90,000 in monthly recurring revenue, $1.08 million a year, before a single walk-up customer even shows up. Multiply that across 20 locations and you have a business generating over $20 million a year in pure membership revenue. That, on paper, requires almost no additional selling effort to maintain. This is exactly the story that convinced private equity firms to start buying up regional car wash chains at a blistering pace. Throughout the 2010s and early 2020s, rolling up independent operators, standardizing them under a single brand, and stacking memberships across dozens or hundreds of locations in a single market. Now here's the other side of the ledger, and this is where the empire strategy starts to strain under its own weight. The first problem is that unlimited memberships are, structurally, a bet against your own customers using the product too much. If your average member pays $30 a month and washes their car once, your marginal cost, water, chemicals, electricity, where on equipment might be $3 to $5. That's an enormous margin. But if that same member starts washing their car 8 times a month because it's unlimited and free at the point of use, your marginal cost on that member can approach or even exceed what they're paying you. Operators quietly refer to these customers as heavy users, and every membership-based business eventually has to figure out how to manage them without alienating the very people who love the product enough to use it constantly. Some operators have begun instituting soft caps, tiered pricing, or slower processing for repeat same-day visits, but every one of those moves risks the exact kind of customer backlash that damages a subscription brand. The second problem, and the one that has genuinely rattled the private equity car wash strategy over the last few years, is churn. Membership revenue only compounds if the members stay. Industry surveys have reported average monthly churn rates in the range of 5% to 10% for unlimited wash memberships, meaning a location can lose somewhere between half and the entirety of its member base over the course of a single year. If it isn't constantly replacing canceled memberships with new signups. That means the recurring revenue investors were valuing at software company multiples doesn't actually behave like software revenue. Software subscribers who value a product they use daily tend to stick around for years. Car wash subscribers, it turns out, cancel far more easily, often the moment a competing wash opens 2 blocks away with a cheaper introductory rate, or the moment a household simply forgets to use it and decides the charge isn't worth it anymore. The third problem is the one baked directly into the roll-up strategy itself, and it's brutally simple. Car washes are not scarce. Unlike a mall or an airport, there is no meaningful barrier stopping a competitor from opening a nearly identical express tunnel half a mile down the same road. And because the entire industry converged on the same $25 to $40 unlimited membership model at roughly the same time, competition between nearby washes increasingly comes down to whoever offers the lowest introductory price to poach members away from the wash across the street. This has led to something the industry now openly refers to as membership price wars, where operators in oversaturated corridors slash new member pricing to $10 or $15 a month just to win the sign-up, eroding the very margins that made the roll-up math work in the first place. A market can absorb 1 or 2 express washes comfortably. Once it has 5 within a 2-mile radius, all fighting over the same pool of local drivers, the membership economics that justified those 10 to 15 times EBITDA valuations start to look considerably shakier. Then there's the fixed cost side, because unlike the fantasy of a machine that runs itself, an express tunnel is an enormously expensive piece of equipment to own and maintain. The conveyor system, brushes, blowers, and water reclamation equipment run continuously for 10 or more hours a day, and are exposed constantly to soap, minerals, and moving vehicle traffic, a genuinely harsh operating environment. Major mechanical breakdowns, a failed blower motor, a damaged conveyor chain, a malfunctioning water reclamation system can cost tens of thousands of dollars to repair, and worse, can shut the entire tunnel down for days, during which membership customers are paying for a service they cannot use. Utilities are another quiet killer. A high-volume express wash can use tens of thousands of gallons of water a day, and even with reclamation systems recycling 60% to 80% of that water. Fresh water and sewer costs, along with the electricity to run blowers, pumps, and heated water systems, add up to a substantial monthly bill regardless of how many cars come through that day. And here's the trap almost nobody sees coming until they're running 15 or 20 locations instead of one. Labor and management complexity scale faster than revenue does. A single well-run location might need a site manager and a handful of part-time staff to handle vacuum stations, customer service, and basic maintenance. But across 20 locations, you now need regional managers, a centralized customer service and billing operation to handle membership cancellations and payment disputes, a maintenance team capable of responding quickly across a wide geographic area, and marketing spend in every individual local market to keep replacing the members who are constantly churning out. Private equity roll-ups are built on the promise that this complexity gets cheaper per location as you scale. In practice, many operators have found that car wash operations resist that kind of centralization far more than the spreadsheet assumed, because each location's competitive situation, weather patterns, and local price sensitivity are genuinely different, and a one-size-fits-all corporate playbook applied across dozens of sites can quietly underperform what a hands-on local owner would have delivered at a single location. To understand how this plays out in the real world, it helps to look at how the industry's boom actually unfolded. Private equity investment in car washes accelerated sharply starting around 2019, with firms acquiring independent regional chains, standardizing them under unified brands, and pursuing an explicit strategy of buying at 7 or 8 times EBITDA and reselling the combined, larger platform at 12 or 15 times EBITDA to an even bigger buyer, a strategy known in the industry as multiple arbitrage. For several years, this worked exactly as designed. Larger, more sophisticated buyers kept appearing willing to pay up for scale, and the whole sector rode a wave of consolidation that saw hundreds of independent washes absorbed into a handful of major platforms. But starting around 2022 and 2023, as interest rates rose sharply and debt became far more expensive, the economics of that arbitrage strategy started breaking down. Deals that depended on cheap leveraged financing to fund acquisitions became harder to close. Some of the most aggressively leveraged roll-ups found themselves holding portfolios of locations with rising debt service costs, churning memberships, and increasingly saturated local markets all at the same time, precisely the combination that turns a beautiful growth story into a cash flow problem. The disruption underneath all of this didn't happen in a vacuum. It happened alongside a broader shift in how much competition each local market could actually sustain. For years, the car wash growth story was built on the idea that Americans were washing their cars more often as unlimited memberships removed the friction of paying per visit. And that was genuinely true in the early stages of the boom. But that same removal of friction is exactly what invited a wave of new supply, because every operator watching the growth numbers concluded the same thing: build more tunnels. The result, in many metro areas, has been a level of express wash density that the local customer base simply cannot support at premium membership pricing, forcing the exact price wars and churn problems described above. This is why the operators who have weathered the shakeout best are often not the ones who scaled the fastest, but the ones who paid closest attention to genuine site selection, chose locations with real traffic counts and limited nearby competition rather than simply filling out a geographic map, and built loyalty through consistent quality and service rather than through the cheapest possible introductory price. Some of the more disciplined operators have also started diversifying revenue beyond the core wash itself, adding detailing services, tiered membership packages with meaningfully different service levels rather than one flat, unlimited price, and loyalty programs designed specifically to reduce the churn that has proven to be the sector's most persistent weakness. So does owning a car wash empire actually work as a business? The honest answer, again, depends enormously on execution and timing rather than the concept itself. In the optimistic scenario, you own a portfolio of well-located washes in markets that aren't oversaturated, with disciplined membership pricing, a management structure that actually captures the efficiencies of scale rather than just adding overhead, and churn kept meaningfully below the industry average through genuine customer loyalty. In that case, the recurring membership revenue really does behave the way the original pitch promised, compounding steadily, requiring relatively modest incremental selling effort, and producing a business that a larger buyer will eventually pay a premium multiple to acquire. In the realistic bad year scenario, 2 new competing tunnels open within a mile of your best-performing location within the same 18-month window. To defend your membership base, you're forced to slash new member pricing, which compresses margins across your entire local cluster, not just the location under direct attack. Churn ticks up as members shop around between 3 nearly identical services differentiated mainly by price. Meanwhile, your fixed costs, debt service on the equipment and real estate, utilities, and now a bloated regional management structure built for a growth phase that has stalled, keep arriving in full regardless of how the membership math is trending. The gap between these two outcomes, for portfolios that looked nearly identical on paper at the moment of acquisition, has turned out to be enormous. And it's the exact gap that separated the private equity roll-ups that successfully exited at premium multiples from the ones now quietly working through debt restructurings with lenders. Let's build a realistic scenario. An operator acquires 5 express tunnel locations in a mid-sized metro for a combined $30 million, financed with 60% debt. Each location averages 2,500 active members at $32 a month, producing combined membership revenue of roughly $4.8 million a year across the portfolio, plus another $1.5 million from walk-up traffic and add-on services, for total revenue near $6.3 million. Operating costs, labor, utilities, water, chemicals, maintenance, and regional overhead run approximately $3.8 million, leaving EBITDA of roughly $2.5 million. Annual debt service on the $18 million in financing at current rates runs close to $1.6 million. That leaves roughly $900,000 in free cash flow across 5 locations, a return that looks reasonable but leaves almost no cushion if churn rises, a competitor opens nearby, or a single major mechanical failure takes a tunnel offline for 2 weeks during peak season. Now introduce a bad stretch. Churn rises from 6% to 10% monthly as 2 new competing washes open in the territory, forcing a membership price cut to defend market share. Revenue across the portfolio drops by roughly 15%, while fixed costs barely move. That $900,000 in free cash flow can evaporate into a loss within a single year, even though the physical assets, the tunnels, the land, the equipment haven't changed at all. A car wash empire looks, from the highway, like the simplest recurring revenue business imaginable, a subscription nobody thinks twice about canceling, attached to a machine that never gets tired. From the ownership side, it's actually a capital-intensive, mechanically fragile, increasingly commoditized business, where the moat that justified the premium valuation, the sticky membership base, turns out to be far less sticky than the spreadsheet assumed. The moment a cheaper competitor opens down the road, the suds and the subscription were never really the business. The barrier to entry, or the almost complete absence of one, always was.